Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a forward contract for speculative purposes only. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to enter that into the blue area on the right-hand side, including our journal entries and then our trial balances and our trial balance worksheet for year 1 and year 2. So we're going to have a forward contract that was created for speculative purposes only, and the components of it are that on 12/1/X1, U.S. company, us, we're the U.S. company, entered into a 120-day forward contract to purchase Australian dollars, and that's going to be 100,000 Australian dollars. We got the spot rates and the forward rates. So when we think about this type of problem, we're kind of breaking this down to the most simplistic kind of forward contract, so we can take a look at the forward contract. As you do so, you want to think about when you're going to use basically the spot rate and the forward rate. So let's just kind of mull through this as we enter it into the system. So we've got on 12/1/X1, we're going to enter this into the system, and then it's a 120-day forward contract, which is basically 4 months about into the future. So date here, we're going to say is 12/1/X1, and the forward contract is basically just going to be equal to, we're going to be putting the receivable on the books. We're going to have a receivable. We're going to call it a foreign currency receivable from the exchange broker. In other words, we're going to expect, due to the contract, to be paid in foreign currency, which is going to be the Australian dollar in the future. And then we're going to have a liability at the same time. We're recording the receivable and basically the payable or liability. That's going to be the dollar payable to the exchange broker. So then we're going to have a payable to the exchange broker. It's going to be in dollars. So the exchange broker is going to be paying us in the future in Australian dollars. Those things will fluctuate in comparison to the US dollar. So that's the thing that we're going to have to account for as it varies over time. And then we got the dollars payable to the exchange broker, the US dollars that we expect to pay, and that is what it is. It's not going to be changing over time. So this one we're going to have to account for with time value money. This one will remain in essence the same. Okay, so then we're going to start off with then the 100,000, and we're looking at here the forward rates. So we're considering the forward rates because we're considering that 100,000 at the end, or the point in time where the transaction will take place. So we're kind of guessing out into the future. We don't know what it's going to be, obviously. So we're kind of guessing out into the future, and so we're using the forward rate as opposed to the spot rate, which is basically the exchange rate as of this point in time, because it's a forward contract. So we're going to be saying, all right, we're going to take the 100,000 times the 0.609, and that's going to be the 60,900. So we'll put that on the books as a receivable and basically a liability and payable in essence. So we got the receivable on the books at the 60,900. So 60,900 is basically representing what we believe, our best guess, to be the value of the 100,000 Australian dollars that we're going to be receiving 120 days from now from this contract from the exchange broker. Then on the US currency side, we're going to have 60,900. No speculation on this point. 120 days from now, we're basically going to pay cash of the 60,900. So we're speculating then on the change that's going to be taking place with regards to the currency. Now note here, what we have is a receivable, right? So the receivable, what we're hoping is we're going to get paid this 100,000 in foreign currency, in Australian currency. We're hoping then that within the 120 days, or by the end of it, the Australian currency gets stronger. Because if that were to happen, then we would be paid in the Australian currency, which would have more purchasing power, and we'd be paying back in US dollars, which stays at the 60,900. So this speculation is speculating, hoping that the Australian currency gets stronger with relation to the dollar by the end of the 120 days, so that when we get paid the 100,000 in Australian currency, it will be worth more than the 60,900 that we'll be receiving and the 60,900 in cash in US dollars that we will be paying. Okay, so then we're going to say that on 12/31/X1, this is the end of the year, so we have to revalue this forward transaction. So we will then revalue the forward transaction. So it's on the books at, of course, that 60,900. Now the forward rate as of 12/31/X1 is 0.612. So in other words, it was before $1 Australian dollar would be 0.609 US dollars, and then now it's $1 Australian dollar is going to be 0.612 US dollars. So if we calculate where we are at this point in time, then the 100,000 times the 0.612 means that it would be worth $61,200. Now we have the receivable on the books at the 60,900. So if we take the difference between the two minus the 60,900, we would have a receivable of $300. That's basically representing a gain to this point in time. We would have, if we got the money now, basically got, another purchasing power of greater of the $300. Why? Because again, before it was $1 Australian dollar would equal 0.609 US dollars. Now at this point in time, $1 Australian dollar is equal to 0.612. So $1 Australian dollars is worth more of the US dollars. It's gotten stronger, and therefore it has more purchasing power. We're going to be paid in those foreign dollars. So if the foreign dollars got stronger with relation to the US dollar, then we would be looking better in that situation. So we're going to then record the gain. So we're going to say that we have to increase the receivable to that amount that we calculated, and then the other side is going to be going to a gain. So we're going to have a gain. So then let's recalculate it again. Let's say I'm going to calculate it this way this time. I'm going to say equals the brackets. I'm going to take the larger of the two numbers we're going to be working with, which is the 0.612, because I want it to come out to be a positive number because we're talking about a debit here, times. We're going to, minus the other rate. And then we're going to multiply it times the 100,000 Australian dollars. There's our $300 once again. So that's going to be the debit and, of course, the credit. If we then post this out, we got the foreign currency receivable up top, double-clicking on it because something's in it. Plus, we're going to pick up that $300. There it is. Now we're at the 61,200. That 61,200, once again, is the 100,000 times the 0.612, which is the current rate that we have. All right. So then the other side is going to be going to the gain down here. So we have the gain going to the other side. Okay, so then we're going to go down to year 2, because in year 2, we're going to have the forward contract is going to expire on 3/31/X2. 3/31/X2. So we've got our ending numbers up top are going to be our beginning numbers down below. And then all the equity accounts here adding up to the 100,300 is in our equity section, what I'm just going to call retained earnings here for us. So then we have nothing in the temporary accounts. So now we're going to say on 3/31 X2. So on 3/31 X2, this thing becomes due. That's going to be the 120 days later have now expired. So now it's 3/31 X2. Let's now calculate what's in the receivable now. So we have the 61.2. What should it be now? It should be the 100,000 times the current rate. Now the question, of course, is where's the forward rate? Because we're always using the forward rate because that's a predictive rate. Why don't we have it here? Because the forward rate would be predicting something in the future, and we're already in the word it's like right now. There is no future point when we're trying to figure out what the money is at the end point, because it is the end point. It is now. Therefore, we just have the spot rate. So we've got the 100,000 times the spot rate, 0.602, and that's going to be the 60,200. If I take this minus the 61,200, that's going to be a $1,000 difference. That's going to be a loss this time. Why? Because before we were at this 0.612. Now we're not going to this 131. We're skipping down here to this 0.602 on 3/31. So we were at $1 Australian dollar equals $0.612. Now $1 Australian dollars equals 0.602. So the Australian dollar is now worth less of a point of US dollars. We get less US dollars. per 1 Australian dollar. Therefore, the Australian dollar has gotten weaker. We're going to get paid because it's a receivable in Australian dollars. So we're going to get paid in something that is now weaker. And that means, we have a loss. So we're going to say, all right, we got a loss here. And this is going to be equal to the loss. And then on the other side, we have a foreign currency receivable that we're going to have to record. Let's calculate it again. Equals brackets. I'm going to take the larger of the two numbers, which is going to be the one on 12/31, the forward, that's where we left off last time, and then minus where we are now, the spot rate, because that is, as of the end, the point in time that we're currently imagining we are in. And then we're going to multiply that times the 100,000. And there's our 1,000 debit and credit. Let's record that out. So we're going to, the 100,000 is going to be going down below. So we are on the 100,000. That's going to be the debit for the loss. Then we have the foreign currency receivable, 100,000. That's going to be the 1,000 here, the 1,000. And that's going to be in the receivable. So now we have the receivable going down by the 1,000, making it go down to the 60,200. That 60,200 once again can be calculated as the 100,000 times the current rate, which is the spot rate, times the 0.602, 60,200. Okay, so then we're going to get the dollars, so we can and we're going to pay off the payable that we have here. So let's go ahead and pay off the payable first, because this is going to be paid in dollars. It's straightforward. It's the end of the contract. We now owe the 60,900. No foreign currency on this side. This is in dollars. So we took out the loan up top. It hasn't changed since the point in time that we took out the loan. Now we're simply basically paying it back. So now we're just going to pay it back in dollars. And so we're just going to say then that this payable needs to go down. So I'm going to put it on top to be the debit. And I'm going to be debiting that amount by the 60,900. Then the credit's simply going to be cash. Cash is going to be going out at the 60,900 as well. Posting this out then, we're going to go to this payable. This equals the 60,900 payable, and then the cash going out up top. We're going to pick up the cash is going to be a credit of that 60,900. All right. Then we're going to have the foreign currency that we're going to basically receive now. So we've got the foreign currency that we're going to get, and we're going to be then removing the receivable. So remember, at this point, this receivable represents the U.S. equivalent of the $100,000 that will be Australian currency that we're going to get. Australian dollars being reflected in U.S. dollars, but we're going to get paid in the 100,000 Australian dollars, which basically corresponds to what we're going to reflect on our books, valuing it as we do with everything else in U.S. dollars on our financial statements at the 60,200. So now we're going to reflect cash that we're getting, but we're basically going to reflect that cash as foreign currency units. We're getting cash in foreign units, not the normal measuring device that we use, which is the US dollar. Therefore, we're going to put it in another account here. We're going to represent the US dollar equivalent of it in this account to show that we have the US equivalent of $60,200, which in actuality is 100,000 Australian dollars. Okay, so we're going to say then that we have the foreign currency units, Australian dollars, and we're going to be decreasing the receivable. We can calculate it one more time. Why wouldn't we? It's good times to do so. It's going to be that 100,000 times the spot rate at 331x2, or the 0.602. So there's the 60,200 and the 60,200. We got the foreign currency in units. That's going to be up top. This is going to be equal to that 60,200, and then we have the foreign currency receivable. Something's in here, so I'm going to double click on it, go to the end of it and say plus, and put on that 60,200, bringing it back down to 0. So at the end of the day then, we've got cash on the books. We have the foreign currency. This is basically, again, currency that's on the books, but it's not U.S. currency. We have $100,000 in Australian dollars that we're representing, just like we would for equipment or anything else, in the measuring tool of U.S. dollars, which is 60,200 at this point in time. And then we have the foreign currency receivable is gone now. We've removed that. It's been received. And then we have the dollars payable to the exchange broker has now been paid off, and the retained earnings reflecting, the foreign currency gain from last period, and then the foreign currency gain this period, or loss being reflected on the income statement.